Today, I'm going to start a new topic in mathematical finance. Today and next week, we're going to be dealing with investments. What are investments all about, and what kind of math we're going to use for that. So we're going to be dealing with investments. And in doing that, I'm going to spend a very good chunk of today, about an hour, building an investment with you in front of your eyes. That's what we're going to do. It's going to be based on a true story. The actual investment we will build is not an actual investment, it's not a true story, but that's going to give me a chance of explaining to you what I call the investment fund life cycle. I'm going to focus on the business first. Just like we had the 33-cent game in the case of option pricing, and just like we had the case of the Goodrich Rabobank swap in the case of credit, today we're going to develop our own example. And it's an example which is not something that exists, it's something that we're going to create ourselves. And that will help us understand the business of asset management. Today we're talking about a new business. A lot of what we have seen so far was based on a business which was related to banking of different types. It was lending, it was option pricing, option selling, option hedging. Today we're dealing with investments. As you will see, it's a different business altogether. A lot of the math is math, right? But a lot of the math that enters into these new sectors with a different purpose. And it's very important for me that you understand how that works. And for that, in the investment life cycle, I want to start with the idea of an investment, what called the conception, which is the why that investment actually happens, or why it makes sense. Then we'll see how it's actually born. Then we will go into how it grows. And yes, we will see also how it dies. We're going to go through all of that. And today is just one example for an hour. And then I will deal, in the second hour, I will deal with with a mathematics framework, but the mathematics framework that is useful to understand a lot of this. So today we're going to do an example, and then we'll do some math to understand this. And then we'll finish today. What I will do next week is I will get more into the details of how the actual investment process happens. Today is very high level. Next week it will be low level. We'll get into specific trading strategies and details and so on and so forth. But I want to start with my example. And this example is one that has to do with the city of Montreal. The city of Montreal is a very, it's an interesting city. It has one aspect of it which is of interest to us, which is that there's a lot of snow in the city of Montreal, more than in Toronto. And the city spends a lot of money cleaning up the snow, more than $100 million a year. The way the cleaning is done is perhaps similar to, I don't know if you have a cleaning contract. Many houses have a cleaning contract which is similar. You pay a flat fee to a cleaning company, and whenever it snows, they will come and they clean the snow for you, right? Yeah. When you do that, I don't know if you or your parents or someone that you know has a contract like that. When you get that from cleaning companies, if on the retail side, the cleaning company will just agree to clean the snow for you, and there's probably not a lot of discussion regarding what happens if you get snow in a weird month, say October, right? Is it under the contract or not? In the case of the city of Montreal, this was a very big deal. The city will have to contract out month by month, and they have to make a decision whether to contract with a company for a given month or not. If you do the math, you see $100 million, how many months of snow do they have? Say 5. If it's 5, it's about $20 million per month, right? And the number that they spend is actually more than that. So to include a month or not is expensive. It's an expensive commitment for the city, right? You understand? Yeah. And it turns out that the cleaning is not done by the city, it's done by the company. So for example, in this example here, you see this snow plow and the truck, they belong to a company that does the cleaning, right? So for a for the city to include a month or not is an expensive proposition. But what happens if they don't? If they don't, a snow cleanup outside of your contract is very expensive. Actually, the first year I used this example in this course, which was around 2003. I've been doing this for a long time, more than 20 years, this same example. It's very good to understand investments. That year in Toronto, we had a very unusual snowstorm in April. And April is outside. Toronto has a similar thing. April is outside of the cleaning contract for the city of Toronto. Why? Why? Why would you pay, say, $10 million for someone to clean the city of snow in the month of April? Why would you do that? Would you do that? Would you pay $10 million to? No. Why? What happens if there's a lot of snow one day? We do get snow in April in Toronto, right? What happens when we get snow? We just wait for the rain or for the sun. That's what we do, right? So we may have a chaotic day, but then in 24 hours, it's typically gone. You wouldn't do that. That year in Toronto, the snow was still there 3 days later. And the city had to call one of these companies, and I read that the city spent 50% of next year's cleaning budget on a single cleanup, right? Why would a company do it for you at a cheap rate if you call them when you can't wait any longer, right? I told you, no one works for free anymore. Since Reading Week, no one works for free anymore, including cleaning companies. So if they say, yeah, I'll clean the city for you, but it's going to cost you $50 million, what do? We'll just do it, right? And that happened in Toronto in that year. So, and that is a very good way to explain why you need an agreement like that on months where, but also it's a lot of money, right? So it's a difficult decision for the city to decide if, for example, you want to have such a cleanup agreement on a month like April. It's expensive, but if it does happen, then of course, only in that case the expense is justified. So it's like an insurance policy. But someone had an idea, a lawyer had an idea, because the ski resorts outside of the city have the opposite problem. Who skis here? You go skiing? You go skiing? Yeah, okay. Have you ever gone skiing in May, for example? The ski hills are happy if people go skiing in May, and they do whatever they can to lengthen that season. So if you have snow like in April or even May, they're very happy, right? On the other hand, if you probably remember, I remember one year, Blue Mountain at Christmas time, it was empty and full of mud. There was not one snowflake in the whole Blue Mountain. Do you remember that? Well, you're very young, maybe you don't. I forgot when that was. That's the risk that ski resorts have. Late arrival of snow or early arrival of spring or even summer is bad news for them. So someone had an idea. Which is to do a swap between the city and a ski resort. Very similar to the Goodrich swap, but you will see. There's something very interesting here. So the way this swap would work is as follows. If there is, say, no snow, you pick your units, you pick your time frame. If there is no snow, then the city will give money to the ski resort. I'm picking the number 10 million because it's a very simple number to work with. Doesn't have to be 10 million. But this is an actual swap. This actually is a true story. And then if there is snow, then the payment comes from the ski resort to the city. You understand? So it's just like the Goodrich swap, except in this case, interest rates is not what triggers a payment. What triggers a payment is a snow event, right? Understand? All right. Good. All right. Very good. So something interesting happened in this case, which is that the city and the ski resort ended up not agreeing to the agreement, but not because the numbers were not right. They were happy with the finance. They were happy with the cash flows. They were happy with everything except one thing. They did not agree on where to measure the snow. The city wanted to measure the snow in the city, and the ski resort wanted to measure the snow at the ski resort. The deal died. This is a true story. Okay? And you can imagine things like this happen every day, everywhere. This is very common. Okay, so what does this have to do with this course? I use this as a way to tell you how an investment opportunity is created from a very realistic perspective. So let's imagine that because I know what I'm going to say, but it could be any of you, right? After you take this class today, imagine any of you would be at that negotiating table minutes before the deal dies. Minutes before, what would you do? What would you do? It's a bit of a shame, don't you think, that a deal like this would die? Because it seems that it was good for everybody. And the reason for the disagreement is not like an earth-shattering consideration. How different is that snow precipitation in the city and in the ski resort going to be? Not a lot, right? So how about we propose something like this? I'm going to propose to them a different deal. The deal is as follows. We do two swaps, not one, but two. I do one swap with the ski resort where we do the exact same exchange of payments. But there, in that swap, we measure the snow at the ski resort. And then I do a similar one with the city where we measure the snow at the city. Right? You see? And let's say that, of course, I don't do that for free. Again, no one works for free anymore. I do that and I charge 10% of the cash flows. So they give me $2 million, which is 10% of the 20 million that would be exchanged, million each, right? And then I would do that deal. This is different from the Goodrich swap, although it is a swap. So the diagram looks very similar, but it's different, right? It's different. So before we continue, let me ask you a question. Is this a good deal for me? We already know it's a good deal for the city. That's what they wanted. And we know it's a good deal for the ski resort. That's what they wanted also. You understand what we're talking about here? Is this a good idea? Is this a good deal? How much money do you need to do this deal? Let's say you need $20 million to do this deal, right? 10, in the worst case scenario, you have to pay 10 here and 10 there. You need 20 million. But you make 10% return. You make $2 million when everything is normal, right? Is that a good deal? 10% return is a very good rate of return. Note one thing, that this is 10% return in addition to interest rates, because the 20 million I have it there in a bank account giving me interest. So if say interest rates are 10%, then I will be making 20%, right? 10 from the fee and 10% from the rate of my deposit. Understand? So this is going to be very important for today and actually for next week. When we measure performance of investments, we're going to always reference that to the risk-free rate of return. This is our spread. It's not like a credit spread. This is our performance spread. Or if you want to put this in the context which is familiar to you, look at the example we covered 2 weeks ago when we did that bond trade. Remember? Whoever was the bond trader, I already forgot, was it you? You were, okay. Remember that I was telling you that you will be paying 10%? Well, the 10%, it was too high. It was, 5 is a usual number, right? All those things are related. So to the risk-free rate of return, you add a spread. This is your cost of capital. So a 10% rate of return is wonderful. It's very, very good, right? It's very, very good. But is this a deal worth doing? If you had, anybody has $20 million? You have $20 million? No? Can you imagine you have $20 million? Can you imagine? Yes? Okay. Imagine you have $20 million. Is this a deal worth doing? No? No? Why not?
I don't know the risk between whether there is snow in the resort or not.
You don't. So you don't know if it's a good deal or not. You just don't know, right? You don't know. You know it's a bad deal or you don't know?
I think it's a bad deal.
You think it's a bad deal. Why?
You can end up paying $20 million in your business.
Yeah, it's true. But you could end up making $30 million, right? No, we don't know, right? So this area where we don't know is where math does its best, right? So let's get into this and let's mathematize this a little bit to see if we gain some knowledge as to what is the right thing to do. So what I'm going to do is I'm going to do a very simple model. I'm going to pick my favorite correlation number. You know by now my favorite correlation number is 50%, right? I mean, you cannot say 0. You cannot say that the snow in the city and the snow in the ski resort are really independent, right? There's going to be some relationship. And you cannot say it's going to be 100% because it could happen that there's a lot of snow in Toronto and no snow at Blue Mountain or vice versa. You have a question? Yes.
To actually get a correlation, presumably they're historical.
Yeah, you can get this. I'm just working with 50 because 50 is the number that I don't need to think, right? It's like I picked the number 10 because it's easy to multiply by 10. So I'm picking numbers which are familiar because I'm not interested in the actual investment. If I was interested in the actual investments, you bet I will be working with the real money and with the real correlation, whatever that number is. But for class, I'm happy with a 50% correlation assumption, right? It's going to highlight the main features of my decision making. Don't forget, I am explaining to you the conception part of the investment idea, right? This is what will give rise, perhaps, to an investment. Perhaps not. We're trying, okay? We're at the conception idea stage. All right, so 50% correlation. Let me pick that number, right? So if that's my number, then suddenly I know that there is a 75% chance that I get the same cash flows from both sides. With a 50% correlation, using the same numbers that we used 2 weeks ago, okay, so you remember, it's a Bernoulli experiment, 2 correlated coins, okay, very simple. There's a 75% chance that I get the same cash flows from both sides, right? Yes, it was 37.5. Remember those numbers? Okay, 75%. If you don't remember the numbers, believe me, this is the right number. Then they said 12.5% chance that we receive payments from everybody. So we make 20 million plus our 2, that's 22.
So it's almost a 90% chance we're making money.
So that leaves a 12.5% chance of actually losing a lot of money, right? So the scenario that who was concerned about, you were concerned. Okay. So that leaves us with a 12.5% chance that we actually lose $18 million. 20, 10 minus 2 that we collect, right? So this is the first analysis that we do. Is that shedding any light into our decision? Do you feel empowered to make a decision now if you think this is good?
Maybe I don't do this because once I default, I will never come back.
Once you default?
Yeah.
You're planning on defaulting? Why would you default here?
Because in maths, I'm thinking if I have although the positive EV decision, but in the real time, if I once I pay them 18 million and I'm default and I cannot come back, but in my I can come back.
But no, why would you default? You have $20 million, right?
Yeah.
You can pay 18.
Another years.
Yeah, you have 20 million. You're not going to default. You will lose $18 million. Yeah.
Oh, sorry. In this case, we're also assuming the probability of participation is also 50% for the city.
The probability, say that again? The probability of precipitation is 50%?
In this case, I'm just wondering if it's...
I don't understand. We don't care about precipitation of snow. We don't care. We don't care if there's snow or no snow. What we care is that it should be the same at the city and at the ski resort. We don't care for global warming in this example, right? We don't care. We don't care if people from the Caribbean come to Canada in this month because it's so warm, right? We collect our fee. We'll have to pay money to the ski resort, but that's coming from the city, so we're fine. Our risk is not precipitation. Our risk is a spread of precipitation. By the way, this type of derivative is called a climate derivative, okay? And we're starting to see more and more and more of these types of derivatives. Okay, so this is actually a very contemporary example. Okay? You can imagine that not only ski resorts, but say this type of derivatives would be interesting in agriculture, would be interesting in other areas of economic activity, right? Yeah. So, but in this case, precipitation is not our concern. Our concern is spread of precipitation between the city and the ski resort. That's our concern. Our concern is that the city is full of snow and the ski resort is no snow, muddy. That's our concern. That's our risk, right? We get compensated with 10% for that risk. Is that good compensation? Yes or no? See, this is the big issue with investments. In investments, there's no such thing as making money for free. You have to take risks, okay? You have to take risks. And a lot of what we will be doing this week and next week is putting a price to risk and see if that return is worth the risk. See what the relationship is between the risk we take and the return we take. And that's why this is a good example. Okay? So let's continue with our measurements. I'm going to develop the investment parameters. The first one is I have to invest $20 million. I'm making an assumption, which is that the city and the ski resort will not deal with me unless I have $20 million. What if I have 10? The city and the ski resort will have to do something which is different from what I wanted to focus on. It's more related to what we discussed last week, which is the probability of default. Because I could default, I don't have the 20 million, say I only have 10, so then I could default with a recovery of 50%. That's exactly what we discussed last week. I'm not talking about credit today, I'm talking about investment. So that's why I'm going to assume we have the money. So I'm going to invest $20 million. My rate of return is going to be an average 10%. Some days will be better, some days will be worse. I don't know, 10%. What is the volatility, which is also the standard deviation? It's 50%. That is how you do it. I have 3 events, and I look at the deviation between my cash flows and the mean, and the answer is 50%. Yes? All right. So with these investment parameters, I can already draw some conclusions.
Sorry, this average return, is that the expected return?
That's the expected return. Yes, expected, average, mean, they're all going to be the same thing to us. Yes. Okay? So with that thing, with those parameters, there's something called the Sharpe ratio that I will explain today. The Sharpe ratio is the division between the expected return, the average return, and the volatility. And that is a number which is 0.2. That is a way to measure whether my relationship between investment return and investment risk is, well, how is it? Is it high? Is it low? In this case, 0.2. 0.2 is considered to be low. Okay, we will learn all these things later. Today. This is for today. So 0.2 is low. So we decided it's not worth it. There are other investments that give me a better sub ratio, so we are not going to do it. And this is why we are not going to do it. We managed to mathematize the decision of not investing in this thing. Yes? Okay, but if we're not invested in this, why am I showing this example to you? What did I say is such a good example? Well, it's a good example because it allows me to turn this bad deal into a good deal. And that's the good deal that I'm going to tell you about, which is we're going to do the same thing for a number of other ski resorts and cities in North America. Okay? I'm going to go to where I have some list here. I'm going to just look at the map of North America, and I'm going to do this in 100 cities and 100 ski resorts, and some of the names are there. I'm going to go to Blue Mountain and the city of Toronto. I go to City Hall, and then I go to Collingwood, and I sell them on the idea. And then I go to New Jersey, and I go to Mountain Creek, do the same thing. And I have here, I go to Whistler, and I go to Vancouver, and I do the same thing. Or maybe Vancouver is the wrong example. May I have to pick a city where it actually snows more than Vancouver. But you understand the idea. I'm going to come up with a portfolio of 100 cities and 100 ski resorts that I can pair. This is very important. I can pair them up so that correlation is high. The higher the correlation, the better the deal is for me. Okay? You understand that? Okay. Now, what happens when I have 100 of these pairs? The investment parameters now change. The first thing that changes is how much money do I need? I need $2 billion. Okay? Who has $2 billion? You have $2 billion? I don't know, maybe you do. Can you imagine you have $2 billion? Can you imagine that? Okay, we're going to imagine we have $2 billion for now, okay? We're going to imagine you have $2 billion. Oops, what happened here? Sorry, something happened here. It went too fast. Something happened. I don't know what happened. All right, so we're going to imagine we have $2 billion here. With $2 billion, I have a rate of return of what? What's the rate of return? What's the expected return? Huh?
0.2 billion.
Well, we like to measure return in percentage points. So what's the percentage return we expect if we do 100 of these swaps with 100 cities and 100 ski resorts?
Still 10%.
Still 10%. That doesn't change, right? Still 10%. What about the other parameters? What about the standard deviation? %. Why? I'm assuming that the correlation between one deal in Toronto, one deal in Montreal, one deal in Calgary is 0. I'm assuming that. But that's a reasonable assumption. If I was assuming, or if I was looking at correlation between precipitation, then no, it's not reasonable, right? If you have global warming, then there's going to be less snow everywhere, perhaps. But that's not what we're looking at. We're looking at the spread between snow in the city and the snow at the ski resort. So I need a very strange meteorological effect that suddenly makes more snow in the cities and less in the mountains. I don't know that. So I'm going to assume that that spread is random. It's good as an assumption for what we're dealing with here. Now, if the volatility is 5%, because if I have 100 of these swaps, as you know, the volatility grows by the square root of the number of experiments, and not like the number of experiments. The square root of 100 is 10, right? So percentage-wise, it's going to drop by 10. Goes from 50 to 5. And now what I find is I have a Sharpe ratio of 2. A Sharpe ratio of 2 is very good. Sharpe ratio of 2 is very good. Think of this investment. This investment with an expected return of 10 on a volatility of 5, if it was a Gaussian, you would expect that you lose money like less than 1% of the time, right? And you're going to be making a lot of money most of the time. It's a very good deal. It's a very good. So this is something that we would do, right? Good. So we got a deal. We got a deal. And I use some math that I'm going to explain a little bit better later today. You understand? Now we got a deal. Okay, very good. What do we do now? So we are at that meeting with the ski company and the city of Montreal and say, no, don't go. We're going to make this deal work, right? So quickly tell your lawyer to rewrite that swap agreement, change the observation time, or the observation place, and send them to me. Just change the counterparty. The counterparty is now me. And so that you trust me, who I am, here's $20 million, which I guarantee they are put on escrow at Bank of Montreal. Why not? And the deal is guaranteed. Just pay me 10% of the cash flows. So I charge you 10%, but you can still get your deal done. Understand? That's how you would do it. Because now I know this is a good deal. Okay? And let's say, oh, this is great. Thank you very much. We will do that. What prevents me from doing that? This is what I call the idea. The idea is great. But it's not going to happen. It's not going to happen. Why? Because I don't have $2 billion. Again, no, this course is real now, right? So I don't have $2 billion. I said, imagine you had 20 million. I can say, imagine you have 2 billion. Well, you cannot sign a deal like this, imagining you have 2 billion. So I don't. Anybody here has $2 billion? No? Anybody knows, I don't know, Elon Musk, and maybe you can convince him. Anybody knows Elon? Jack Ma, maybe? You have friends who have $2 billion ready to, no? Do you have friends with $2 billion? Maybe you need new friends. No? No. Now, what you need is something different, okay? So what happens? These things happen all the time. What happens if you're in a situation like this and you say, if I had $2 billion, this is great, right? I could do something. What do we do? Well, this is what this part of this course is all about. This is a different business. I could say, I call my bank. I have a great bank. I call the Bank of Montreal. I say, Bank of Montreal, would you give me a $2 billion loan? Would you? Well, that follows under the discussion that we saw last week. What do you think the Bank of Montreal is going to tell me? First, they're going to ask me for collateral. What's your collateral? It's not going to happen, right? It's not going to happen. You can say, but this is a very good business, right? Do you think the Bank of Montreal will invest in a very good business? That's not what they do. Investing in good businesses is what investors do. It's not what banks do. Banks will give you a loan. But a bank is not going to lend you $2 billion so that you can make $200 million and then just pay some interest back to them. No, this is what other companies do. And this is the part of the financial sector that deals with these opportunities is the asset management sector. That's what asset management is. Investment funds, pension funds, that's what they do. Banks don't do this. So today and next week, we're talking about a different part of the investment sector. It's the one that's relevant to you. If, for example, You end up working at a mutual fund. You end up working at a pension fund. You end up working at an endowment fund. You end up working at an insurance company, because insurance companies have to invest too. Okay? The investment sector is part of the financial sector, but it's very different from banking. We've talked about banking-related businesses for most of this course. For 2 weeks, we're talking about investment opportunities and how math enters into that. So we're moving into the mathematical finance of the investment sector. All right. So to go from this idea to the birth of this process, I need something new, something that I want you to understand. There is no math in going from the idea to the birth. There was perhaps some math in the development of the idea, but to go from the idea, from the conception to the birth, no math. It still is important that you know, because if you end up in this sector, you will have to deal with a lot of non-math issues all the time. So I need you to know them. All right? Okay, so let's say that some of you does have a friend who will give us some money. Let's say, okay? Let's say that each one of you has a rich friend. Yes? You have a rich friend? Anybody has a rich friend? No? You can call Elon Musk. What happens if you call Elon Musk and say, I have this investment opportunity, and he says, oh, that's interesting. That's a new way of making some money, right? Or perhaps more realistically, let's say that you call the Canada Pension Plan and say, hey, I have this investment opportunity. I heard you're looking for a return on your $500 billion fund. Maybe this is of interest to you, and they would probably say yes, right? That's a bit more realistic. What happens then? Let's say that Canada Pension Plan is interested in giving us some money. They're not going to give you all the money. They're going to give you, say, oh, you need $2 billion. Maybe they give you $200 million. So that's great. You call 10 other pension plans, you raise $200 million from each of them, and you're good to go, right? Yeah? That's what you do. How does that work? I want to talk to you about that, okay? And this is why funds exist. This is what a fund is. You need a fund to do this. You cannot do this without a fund, okay? You don't go to your friends and say, give me some money, and then they give you the money in cash or put, check. And you take that money, you collect it, and then you go and you invest. You cannot do that. Why can you not do that? You need to regulate that process. First of all, this process is very highly regulated. You do that, you go to jail. You cannot do it like that. Okay? You have to create a company, but it's not a company to take the money. The money goes to another company. It's a fund. The fund is a trust, and it has a precise legal structure. If there was a course in the Faculty of Law, I will be speaking for weeks and weeks and weeks about how to create a fund and what different variants of the fund there are in different jurisdictions, and so on and so forth. And many of you will have to learn that, but not today. Today, you just accept the fact that there is a legal structure called a fund that is able to take money from your investors. The money does not come to me, it does not go to you. It goes to a fund. The investors get shares when investing into the fund. So it's very similar to a company, except it's not a company that produces, metallic tubes. It's a company that takes money, invests money, and gives money back to the investors. Different kind of company. It's called a trust. But I do have to create a company for 2 reasons. First is this fund has money, but there's no one in the fund to manage the money. Who is going to sign the swap agreements with the city of Montreal and the ski resort? Who's going to do that? You're going to call your investors? You're going to bother Elon Musk in the middle of his tweeting to sign a swap agreement with 100 swap agreements? No, it doesn't work like that. When you set up the fund has a lot of money, but the fund has to hire a company that's going to manage all of the operations of the fund. So that's a company I will set up, for example. I set up that company. And this company has a contract with the fund so that the company can do all the things that the fund needs to do. Like, for example, open a bank account. I need to put the money somewhere. So who's going to sign the bank documents? Well, the management company will do that. The management company will send the swap agreements. The company will hire a broker if we need a broker, right? And we also have to hire other types of service providers. We need an administrator. An administrator, to put it very simply, is another company whose job is to count the money. That's all they do. And they report that to the investors. So you tell your investors, oh, you put in 50 million. Well, your shares are worth 52. So, oh, that's great. Who does that? Do we do that? Typically not. Why? Because the investors should not really trust our numbers. We are an interested party, so you need an independent verification of the value of their investment. That's what the administrator does. And on top of that is an auditor who every year checks that the administrator didn't make a mistake. Okay? So there's no math here. But without something like this, an investment will not happen. The idea will be a great idea. It's never going to make anybody any money. Clear? Understand? Yeah? Okay, great. Now, the fund has also other considerations that one needs to take into account. One of them is, this is one of my favorite ones to talk about, which is all of these service providers, they should be conflict-free. What does that mean? Imagine that the management company is also the administrator, as I said earlier, right? Then the management company is the one telling the investor how much money they have. What happens if I lose money? What would I tell my investors? You lost money? Well, I should. But what if I decide that's not good for my business? Yeah? Or imagine the management company is also the broker. I do a deal and the deal doesn't work. What do I tell my investors? What do I tell the administrator? This actually, it may look far-fetched, but actually this happened. Do you remember, this is going to come up a little bit later, I'll just explain to you now. Do you remember a name, does a name ring a bell? Bernie Madoff? Does that ring a bell? Bernie Madoff or Madoff? Yeah, you remember that? Yeah.
Ponzi scheme, right?
It's a Ponzi scheme, yes. And a Ponzi scheme is a very interesting investment activity whereby you take money from investors who want to invest in your fund and you give it to investors that want to take their money back, right? However, a Ponzi scheme refers to an illegal activity where the way you do that is you lie to the investors. And to maintain your lies, what you do is to the investors that want their money, say, yes, no problem, here's your money, right? What happened in the case of Bernie Madoff, which is coming a little bit later, is that's basically what he did. And I'll explain this to you in more detail. And why did that happen? Because he was the broker. If you look into what he was doing, he was also the broker. So he said that he was doing trades where he was making money. It's not true. He was not making any money. He was just taking the money from the investors in the bank and sending that who knows where, but outside of the fund, right? And then because you are the broker, you can create bank statements that said, oh, I did a trade and I made $100 on this trade. And you give it to the administrator who receives that and said, oh, you did, because it says here in the broker's statement that you actually made money. That's great. So investor, you're making money. Not true, right? So here you have a situation where the management company, the broker, and the administrator was The administrator would have doubted those numbers and asked for additional proof, but they didn't do that. Why? Because there was an administration company who had a $50 billion business with this fund, as a result of which was making millions and millions per year and had a single client. So what happens if you start being nosy with your single client who perhaps is stealing money from the investors? What is going to happen? You lose your money, right? You lose your business. So this company was there very quietly, just approving documents until the auditor, I think it was Deloitte, I forgot, said there's something wrong here, and 1 year the whole thing was discovered. Right? But this is very interesting because we have a situation where you have a management company, you have a broker, and the administrator, all of which were somehow in bed with each other. And this is why I say these things have to be conflict-free. Not to imply anything by this, but mutual funds run by big banks, that's how they usually run. The management company is the bank, the broker is the bank, and the administrator is the bank. Right? Okay, so that requires a different type of oversight that I'm not talking about. There is a lot of things to say about this, which, maybe for a different course. So in this diagram, you have a very interesting division between the investors, the owners of the fund, which are on the top, and the service providers of the fund, which are at the bottom, okay? Somewhere in the middle, you have the directors. The directors are people who are not employed by anybody. They just watch what's happening, and they have the legal obligation of determining when something wrong is going on, okay? Director, I may say something about that next week when I describe some of the trading strategies and some of the cases that actually happen. So this is how a fund is born. You need to do this if you want this example to actually go forward, right? So let's say I create my management company because I need to do this. The management company is going to earn money from the fund. And right? I'm going to charge the fund. I'm a service provider. The fund pays everybody here. The fund pays the bank, the broker, the management company, the auditor, and the administrator. And then the fund makes money. We're going to see the financials of that. But let me talk about the management company a little bit. If I'm going to run a successful business for my management company, I need this fund to work. That means that I need to hire people for my management company. Okay? Let's say I'm the CEO of the management company. Let's say I had the idea, I set up the company, I established the contract with the fund. So yeah, I'd say I run this thing. But then I'm going to need people to run my management company. What kind of people do I need? Is any one of you interested in working for me? You're interested in working for me? Yeah, what would you do?
Statistical calculus.
What are you going to do?
Statistical calculus.
You're going to do the statistical calculations. You're going to calculate my correlations for me and things like that?
Yeah.
Okay, let's say you're hired. Good. Okay, I got you. Great, perfect. Anybody else wants to work for me? You want to work for me? Yeah, what are you going to do? You're going to be the lawyer. Fantastic, you're hired. Okay, great. Thank you. I need a lawyer. Yes. What about you? What?
Accountant.
The accountant. Okay, so you're going to be my chief legal counsel. You're going to be my chief compliance officer too. Do you mind? I'll tell you what that means, okay? Say yes, yes. You're going to be my chief financial officer, right? Not accountant. I need maybe you hire an accountant. I need a chief financial officer. You're going to be my CFO, right? Okay, good. Okay, I got my CFO. I got my CCO. What are you? My correlations guy. No, what are you?
CTO.
But that's different, right? Then you're not going to do just correlation calculations. Okay, think about your title. Okay, who else wants to work for me? Yes, okay, what would you do? Okay, that's good. So then you're going to be my sales guy, okay? That's the most important part. We're going to go with our sales guy, right? You have to talk to Elon Musk all day long and this and that. Get me the $2 billion. That's your job, right? Okay, got it. What are you going to do?
Risk manager.
You're going to be my risk manager. Oh, that's interesting. Why do I need a risk manager? What?
To stop you from making risky investments.
But I have him for that. No? No, this is what you just said is very interesting. All right. Remember the example of that bond trade we did 2 weeks ago? I forgot who was trading, but there were two people trading. I said you were the bank, and you were the hedge fund, right? Okay, all right. So the bank needed a risk manager, right? Remember that example? Because the risk manager is the one that was asking him to put $1.47 on day one to do that deal because there was risk and there was regulatory capital, right? Okay, where's the regulatory capital of my fund or my management company? I don't have any. Okay, so why do you want to be the risk manager? Why would I hire you? Convince me why I would hire you. Maybe I don't need to hire you. Do I need to hire you?
You would, right?
Huh?
Yes, you would.
Why? If I was a bank, I would not hesitate. Yes, I need a risk manager, otherwise I cannot run my business. But I'm running a fund, you know, Elon Musk doesn't seem to care that I have a risk manager. Right? My sales guy tells me that I don't need a risk manager to raise my money. Do I need a risk manager or not?
Maybe.
Okay, I do. And this is what I want you to know. I need you to understand how the businesses work, because you need to work at some point, right? Well, how can you be hired if you don't know if they need you, right? Why would I need a risk manager? Well, my chief compliance officer right there, you're a lawyer, right? How much do you know about risk? Well, you took this course, don't say that. Okay, no, sorry, you didn't take this course, you're just a lawyer, right? So you're a lawyer, you're the chief compliance officer, right? If something happens and the regulator said, but what were you thinking? Yeah, so yeah, hire him. So, but you will probably work for him, right? So I'm the CEO, I just want to make money, right? But he's my chief compliance officer. He says, oh, according to the regulations, we need to have a risk manager, so he will probably hire you, right? Or not, maybe I have to hire you. Because according to certain regulations, I need the risk manager who actually reports directly to the CEO. This is very common now, right? So maybe you need to report to me directly, and he's going to worry that the swaps are perfect, and then you worry that we're not taking too much risk on behalf of the investors, because then we can be in trouble. That's why I need you, okay? Sometimes I need you because the investors insist. Sometimes I need you because the regulators insist. I'm not a bank, I'm regulated differently. If you go back to one, I think it was many weeks ago now, I gave you a very big chart of regulation for the different sectors. There was banking, there was insurance, and there was asset management. I didn't say very much about asset management then, but I'm telling you now. If I was to bring that chart back, it was a table, you will see that somewhere there we say we need risk management. Okay? So yes, you're hired, okay? It was a long discussion, but you need to understand these things, right? I don't manage risk just because it's fun. Banks don't do that either, okay? You do it because someone is asking you to do that. In the case of the bank, it's the banking regulators. Here, could be the securities regulators. Could be, right? So very likely you'll be hired by him. Okay, great. Do I need more people? Anybody? You want to work for me too? What do you want to do? You're going to be what?
Researcher.
Researcher. Giving me advice on what?
Strategies.
Strategy. What strategy?
Like I can model the stocks.
But hire him for that.
He's only doing the numbers.
Oh, he's only doing the numbers. Well, why would I need so many people doing numbers? You're doing numbers too. No? I'm acting. You know what I mean, right? Okay. So he will do that.
But data analysis and like modeling is somehow different, right?
You understand the difference. People will probably not understand the difference out there. Yeah, I don't think.
Okay.
No.
Then I can be maybe a fundamental research person.
Fundamental. You're splitting hairs. No, I don't see the difference. I don't see the difference. Do you need help? Do you need to hire someone? Do you have too many correlations to do? You don't have enough?
You're a trader, sir?
What?
Traders?
Oh, a trader, yes. In fact, what I do need, no one has offered to be that, is my chief investment officer. Someone has to make the decisions of what I invest in and what I don't, right? Because he's just giving me correlations, right? Someone needs to take ownership of the trades we do. No one has offered that yet. Someone has to say, this, we're doing this trade is good for our investor, we're going to make money. Who's doing that? Are you doing that, the chief compliance officer, the lawyer? No, you're not doing that. Are you doing that? You're the chief financial officer. You just count money all day long, right? You're just selling, right? Who else was there? I forgot who else was there. No one, no one is my chief investment officer. No one is saying, I will make up that portfolio for you. That, by the way, that's the best job, eh? That's the one with the big bucks, right? So forget about model. That model, no. Chief investment officer. Do you want to be that? Okay, good. Okay, great. Okay, that's good. So what else do I need? Yes.
Maybe I can be your cost controller.
My what?
Cost controller.
No, that's him. Well, do you need help? No, I think he's fine. He's very good. He doesn't need a cost control. He's my CFO. Now, this is something interesting here, because when I say it's my CFO, he's the CFO for what company? For the fund or for the management company? You need to do finances for two entities, right? You need to do finances for the fund, and you need to do finances for the management company, which are different, completely different, right? So which one do you do both, right? He's offering help on which one? On the management company. When you say cost cutting, I imagine you mean what? You mean the management company cost cutting or the fund cost cutting?
The management.
The management company cost cutting?
Yep.
Okay, all right. How do we cost? You're going to help me pay her less? Is that what you're suggesting?
Maybe I will decide like which department you need and which department actually.
Okay. Now, if you want a good job, I would not do that. The management company has very few expenses and not a lot of income. If you offer me to cost cut on the fund expenses, oh, now we're talking. Okay, fund expenses. What fund expenses? Now this is getting real very, very quickly. What fund expenses? Brokerage fees, for example, right? Every time we buy a stock, we have to pay. How much do we pay per stock trade? Huh? How much?
I know it's 1% per share price.
1% per trade? That's a lot of money. Can you help me get, if I'm paying 1%, damn, I need someone like him. I need to pay 1%. Oh my God. That's a $2 billion fund, right? If you're telling me that we're going to spend 1% per trade, how much am I trading? Just if I turn my portfolio around once a year, if I'm spending $20 million on fees, how much can you save me from $20 million of fees? I'm listening. How much can you save me from $20 million of fees? Can you save me half of that? Say yes, say yes, say yes.
Yeah, I will try to.
Okay, well, no, don't say you try your best. No, you have to say, yes, I'll save. If you save me $10 million from the fund, that's good. How much would I pay you? Okay, let's go for the payment section later. Hold that question there. How much will I pay you if you save me $10 million a year in fees? Because you're not saving me, you're saving the fund, right? Maybe I can say, you know what? I don't care if I save money to the fund. Why would I spend money hiring him to save money to the fund? Why would I care? Hold the question, okay? The question is coming back. Okay, guys, so maybe you're hired, maybe. Anybody else? Anybody else? Yes?
CTO.
My CTO. Okay, so you're going to be my CTO. Well, he wanted that. Well, okay, fine, you can be my CTO, which means what? You keep my servers running, or what are you doing?
Yeah, servers running, data software,
Okay, maybe you offer the lawyer a fantastic, large language model set up so all of the swap agreements are centralized and, the swaps get written by themselves, maybe. Okay, yeah, maybe I hire you. Anybody else? Anybody else? Looks like I'm very well staffed, right? What?
Human resources.
Human resources is a small firm. I mean, if I was IBM, but look how many employees I have, right? He will do it. He will do it. My CFO will do it. No. Right. Maybe we need some summer interns. Maybe. Yes. Say that again. Maybe I need some marketing person, right? So what do you think, sales guy? So I get a communications person, marketing. Who wants to do marketing for me? Anybody wants to do marketing for me? I have sales. Do I need marketing? Maybe. It's a small firm. Maybe I can be convinced. Okay, so you understand how this works? Okay. When you're working on that, who's your employer? Who's your employer? The management company, right? Yeah. So if you are going to be working in the asset management sector, you will probably work for management companies. Typically, you will work for management companies. Okay. Some people say, for example, they work for a hedge fund. Can you work for a hedge fund? Not really, according to this, no, right? I just told you no one works for the fund. You will work for the management company that manages the hedge fund. So when people say they work for a hedge fund, that's what they really mean. They work for a management company that manages a hedge fund. Okay, so this is interesting because now, well, there's some nomenclature here. It's, LP, GP, not interested. I'm just going to move on. There's also something interesting here, which is what's called the master feeder structure. Sometimes I have my investors who are in different parts of the world, and I need to find a location for my fund, which is in different parts of the world. Gives rise to very interesting situations where I have a master fund probably in Cayman, and then I have a feeder fund for my European investors, another feeder fund for my Asian investors in Hong Kong, and then you end up having very interesting investment structures. And my lawyer is going to set up all of that. And at the end of the day, the guy doing the correlations doesn't care because all the money comes from the master fund. The chief investment officer cares a little bit because maybe some trades you cannot not do in parts of the world. You have to, something for tax reasons. The feeder fund one needs to close all the positions at the end of the year and reopen them in January. So you decide that, okay? This affects everybody, but we're not talking about that here, right? Each will have its own set of administrators and auditors and service providers and this and that. But now this is the interesting part, because why are we doing this? We're not doing this for free. Again, we stopped working for free. In Reading Week, we stopped working for free. So we do this for a fee. And in the asset management sector, different companies charge different fees. The first fee that almost everybody charges is what's called a management fee. A management fee is a fee which is a percentage of the assets we manage. Here we have a $2 billion fund. Let's say we're going to charge 1% of that. So the fund is going to pay the management company. CFO, how much is the fund going to pay the management company? CFO. You are the CFO, right?
Yeah, 1%.
1%. 20 million. All right, that's good. That's some income. All right, good. Now, in our case, we might charge a performance fee, right? So in this case I'm going to charge a 20% performance fee. Do mutual funds pay a performance fee? No. They charge a management fee. Why are we charging a performance fee? Seems to be a standard in the industry. Okay, there are other reasons, I'll tell you later. Let me, for now, go with a 20% performance fee. Yes?
I was wondering for the profit and loss, so if we lose money, are we paying the investors
Say that again?
20% of our loss?
What? Say that again?
Like if we lose money, are we paying the investors 20% of our?
No,
Okay.
we don't.
Okay.
No, that's bad business. We're not doing that. Not in this case. There is a fee structure here. I'm not talking about that, where you actually do, but I'm not talking about that today, okay? That's very rare, very, very rare.
So the performance fee is proportional to the profit?
How much? I have the financials for my fund coming. In fact, let me just see if that's what I have. Maybe that's my next slide. Let me see. Yes, I do. Let me talk about that. I have the financials here. Okay, so this is what the CFO will do. I have a very simple table that includes the financials for the fund and the financials for the management company. Okay, so let's go through that. I have $2 billion invested by the investors. We invest nothing, so the invested amount is $2 billion and zero. It's only millions of dollars in my. And then 10% of the 10% of investment gains that we mentioned earlier becomes $200 million of gross P&L, profit and loss for the investor, not net. Net is net of fees, right? Gross of fees. So we make 200 million. Your trades make 200 million, all right? Good. Of that, you just said that we're going to take $2 million from the fund to the management company. So there's going to be a transfer of $20 million from the fund to the management company at the end of every year. These things get paid quarterly usually, but here I'm assuming just annual, okay? And then I have $180 million net. So 20% of that, which is 36 million, to go from the fund to the management company. Yes? Yes? Good. That leads a net gain to the investors of 144 million and a net income for the management company of 56 million. Right? Understand? Yeah? Okay, that's great. So let me ask you a question. Which column do you like?
Performance fee. Performance fee.
No, column. There's two columns. Investor, manager.
The second column.
You like the manager? Which one is the second? The manager?
Yeah.
And who likes the manager column? Who likes the investor column? All right, okay, good. I like both, by the way, okay? It's just that you need to know in which column you are. You need to know in which column you are, okay? Some people will prefer the investor column. Why?
Just like the investors.
If you don't like to work, that's the one you pick, right? If you like, yes?
Is it the case that at a hedge fund, the management company also is a lot of the investors?
No, it is the case that the manager would put some of its money into the fund. It can give rise to very interesting. For example, let me ask a question, okay? How much shall I pay you, each of you? Start with the lawyer. How much shall I pay you? Lawyer. Huh? 1 million? That's your salary? 1 million per year? Fine, done. I got it, okay? Good. How much shall I pay you, CFO? $1 million also? Got it, million. Okay, good. How much shall I pay you? Huh?
At least 5.
How much?
5 million.
5 million? No, I'm not paying you 5 million. No way. If I pay you 5 million, what will happen?
I have some traders beneath me that I need to pay them.
No. If I pay you 5 million, you just collect the check every month. You don't have to really get me the returns I need. So I'll pay you a bonus.
Okay.
I'll pay you next to nothing, say $200,000 a year. But then I pay you a bonus. What should the bonus be? I'm collecting 20% of the gains, right? So let's say I'm giving you 10% of that. It's not bad. You will make $3.6 million bonus this year. Do I care? I'm happy. I keep 90% of it, right? You see? Yeah? Okay, how much shall I pay you?
Yeah, I was going to say I want to make a commission, but
Yeah, of course you want to make a commission. How much?
between a commission and a bonus.
Oh, you bet you're going to be paid on a bonus. Absolutely. You bet.
But like functionally, is there a difference between a commission and a bonus, or are they just
Oh,
like if
no, yeah. The bonus is typically discretionary, right? With you, I could argue. I could pay you maybe a commission and a bonus, or let's not distinguish today. Okay? But what shall I pay you? You're my sales guy.
Yeah, I'll take 15% of the returns.
15% of the returns.
10% of the returns.
What?
15% of the 20%.
15% of the 20. Wait. Let me argue, okay? Why would I pay you for performance when you're not in charge of performance? She is.
Well, I mean, without me, people wouldn't be giving the fund money. So you wouldn't even.
No. Wait. Without her performance, your job is very difficult. I understand that. Why would I pay you for performance when your job is not translated into performance?
So my job is bringing money into the fund.
Exactly, yeah.
So if no one's investing into the fund, you have no money to invest in it.
I know that, but why would I pay you for performance? You're talking about this performance, right? No, I would pay you a piece of that. That I would pay you.
Maybe a piece of the -20%.
I know, I gave you a piece of the 20. That's what I would do.
Okay.
I may pay you 20% of that. I may pay you 20% of that. So that means you're going to make $4 million. But I'm not going to pay you for that. I'll pay her for that, right? Yeah? Okay, so I got 3.6 million, 4 million. CFO, how is am I okay? Am I okay? Am I still making money after all these salaries that I pay everybody? You million. How much I pay you?
I think,
Huh?
I think it's different, like, because, like, I'm saving money for you, like.
Sorry, correction. You're saving money for the investors,
Yeah.
right? Okay, good. So let me go back to what we were saying earlier. Let's say that in your case, you save the investors $10 million of fees. I mean, I don't have any fees here, right? Let's say that the fees go, if it wasn't for you, instead of 200 million, the investors would have made 190 million. You save them $10 million of fees, right? That was your job. How much shall I pay you for that?
I think, like, a portion of the millions I save,
How much?
5 to 10%.
5 to 10% of the money you saved, right?
Yeah.
So you saved 10. Let's say 10%, right?
Yeah.
Okay, let's say 10%. No, 10%. Let me explain. So CFO, let's explain something to him, okay? So you are saving the investors $10 million. $10 million for us, we collect 20% of that, right? So the $10 million you save the investors means $2 million for us, for the company, right? You want half of that.
Yeah, so maybe like 2% off.
Well, now we're talking. But see, this is important. Everybody needs to understand this. When you go and get a job, you need to understand where that money is coming from. So one of the things that, and now in the case of investments, it's easy because they're typically flat structures, right? When I told you that everybody stops working for free in reading week, something we have not been doing enough is for you to understand, once you have a job, where is that money coming from? And I'm surprised by some, students when they get a job and I ask them, oh, I'm very happy I'm doing this and that and that. I say, great. How much money is behind what you're doing? You're doing correlations, right? How much money is behind that? Oh, so I don't know. Okay, do you want to know? No. How can you not want to know? How do you know if you're charging the right amount, right? Or how do you know if your job is at risk? Your job is not at risk because you do the wrong correlation number, right? Your job is at risk because we start, having bad performance or the amount of money. No, he doesn't raise 2 billion. He raises 40 million. What happens if I raise 40 million there? Whew. I got 4 million there. It's not even enough by my lawyer, my CFO, that's it. And then why would I hire a correlation guy? You see what I mean? Sorry, I didn't need you to answer. You understand what I'm saying? Yes.
So in practice, how do you actually find out these numbers?
How do you find what numbers?
Well, so you're telling us one has to know where the money's coming from and how much money there is.
Yes.
But unless you're on the inside of the company, how do you find out?
You're getting the inside. Take people for coffees. You need to find out. Again, I'm not saying that you have to go to the boss and say, I demand you tell me what, because then you're fired, right? But you need to have a sense. How big is the trading book, right? Are you trading $1 billion book or are you trading a $100,000 book? You need to know, right? I like to say, especially to mathematicians, that when you're in your career, you can follow the equations or you can follow the money. Okay? With luck, you follow both and they're both together, but not always. You need to know if you're following the equations or you're following the money. You understand what I mean by that, right? Exactly. So just be aware of where you are. Some of my students, for example, are very happy. They are doing, they asked me to do these great models and they're very happy with that. It's great. I have no opinion. Their happiness is great, right? How much money? Imagine. They don't know. They're very happy with the equations. Maybe you're like that. There's nothing wrong with that. Just be aware that there's another option, which is, I'm doing this, but there's $1 billion there. And we're going to make $56 million this year. And I think I have the right, or maybe I can negotiate that I can get a piece of that because of what I do. You understand? You need to be smart about these monies. In a certain sense, this is the most important slide of this course. In the sense that for many of you, you're going to be probably working in this industry, right? And most of you chose the manager column, which probably tells me that that's where you would like to work. So just like I asked earlier, what would you do for me, for my fund, and you had proposals and suggestions, that is a little bit of the attitude when you get into this sector. Okay, you have to know both columns. You have to know both columns always, all right? But that helps you guide as to where you want to be. Because if you understand what your contribution is to column number 3. Your contribution is to column number 4, so this one. That's your contribution. Your contribution is this one, right? What's your contribution, Chief Compliance Officer? If you leave, I have to shut down my business, right? I'm happy you work $40 million. That's great, thank you, continue, right? Yeah. And you? Well, same thing, maybe, right? You understand? That's your value add. Yes? Very important. By the way, you're all in the investor column already. Someone is managing your money while you're here listening to me. It's not so bad to be there, right? Other people are doing the work, you're doing no work. Why am I saying that you're in the investor column? You say, well, I don't have any investments. Do you? Really? You have a pension, right? You've made a CPP contribution in your ever? Anybody has never made a CPP contribution? You've never made? If you've never made a CPP, you've never made a CPP? Never? Okay, well then you're probably not an investor yet, okay? But most of you have, right? If you've TA'd, you work at a coffee shop, you've made a CPP contribution. That means that you're already there. Someone at CPP is there. But then you yourselves could get a job at CPP and then you are in the manager column too. You manage your own money. This is fantastic, right? Yes? So I want you to understand this. It's very, very important. Very, very important. Now, let me continue. Something very interesting here, because now we do these totals here and then the investor is only making 7.2%. Right? You can say, well, that still is pretty good. They should not complain. But for example, there's something interesting here, which is that for the Chief Compliance Officer, when we do marketing material, and I don't know who was doing marketing for me, that was you, maybe? I don't know, someone was doing marketing. We cannot tell the investors that we're making 10%. It's illegal, because it's not true. They will be making 7.2 on average, right? We have to report the numbers after fees, right? Okay, there's a lot of interesting points to discuss here, but I'm just going to continue. Let's say that we do a lot of deals and something bad happens. Okay, I'm going to tell you what will happen. Let's just say something bad happens. So let's say we lose money. That's, I think, what you were asking me earlier, right? We lose money, too bad, no performance fee. So sorry, your $200,000 salary stays, okay? No bonus this year. Sorry, okay? Do better next year, okay? But your $2 million, your, what did I pay you? 2%, 10%? I forgot what I paid you. But the management fee continues to stay there. So on a bad day, on a bad year, we still make 20 million. The investors may lose 80, but we still make 20. No one touches that. Understand? Another thing to understand, because then you're all related to different columns in your job. You want to understand which column you are. So of course you are in a column that this year is not going to be very profitable, but you better know, right? And whoever is under you will be in the same situation. Let's say that you are doing correlations for her, right? I'm not going to have, there's no such thing as a chief correlations guy. It doesn't exist, all right? You will probably work for her. If we have a bad year, you have a bad year. She makes no bonus, you make no bonus, right? Understand? It's very important, right? If you do correlations for, I don't know, for him, he still is making $4 million that year, right? So maybe it's very important to understand where you're working. Understand? Okay, so the different jobs you have correspond to different rows. All right? All right. Now, let me just move over. Now, something very important to understand, and this is especially relevant for hedge funds and other funds which are not regulated. When you have a hedge fund or a fund which is not regulated, the relationship between the fund and the investors is in a document called the offering memorandum. The offering memorandum is the one that has everything that we've talked about has to be said. Like for example, I say I charge 1 and 20, 1% management fee, 20% performance fee. How do we know that? Where is that written, right? There is a legal document, which is part of the structure of the fund, that has all those details expressed. It includes, for example, portfolio and investment guidelines. Let's say that some of these snow swaps, one year they just don't happen. Can we go and buy some stocks instead? Depends. We have to check the offering memorandum. What are the portfolio guidelines? Oh, it says we can only do snow swaps. Then that's all we can do. Oh, it doesn't say anything. We can do derivatives. Oh, let's get some options on the S&P 500. Okay, and then one day you decide, oh, you know what? It's a lot easier to do this than to do snow swap. Let's just do that. And then our performance goes down the drain. And they say, well, tell the investors that nothing wrong, because that's what the offering memorandum says we can do, right? The offering memorandum may also say how much we get paid. That is in the offering memorandum. We say 1 and 20 or 2 and 20 or 3 and 20 or 3 and 50, whatever the number is what the number that's written there, right? Valuation principles and methodologies, they will be in the offering memorandum. Who is my administrator? Now, this is not an employee. Who wants to be my administrator? Some of you are still unemployed. You don't want to work? You are not going to succeed. I can tell you, you're not going to succeed. Who wants to be my administrator?
Should this be a third party?
A third party, yeah. You have your own company now, and you want to be my administrator. Thank you. Yeah, I have some. You may do well. Okay. But you have to be faster, okay? No, it's good advice. Yeah? You hear, oh yeah, I got an A+ in this course, and then what? There's a job and you don't apply? No, you have to apply. Okay, so you're hired. Great. Let me ask you a question. How would you're a mathematician, right? You took a course and you know how to price derivatives, yes? Fantastic, good. How do you price a snow swap? This portfolio is full of snow swaps, right? How do you price a snow swap? I signed this deal with the city and the ski resort in August, and now he wants to report to the investors at year end in December the value of the fund. We have $2 billion, but he needs to send the investor newsletter. Said, this year we've made so much money. And you're the administrator, the number comes from you. How would you value my portfolio in December? And then you're thinking, damn that APM466 course. They never taught me how to value snow swaps. We did this swap with Rabobank or something, but no. Or yes. You're gonna go and revise your notes in pricing theory to see how you can price a snow swap? Is that what you would do? I would not do that. What I do is I go to the offering memorandum, right? There has to be a section on valuation. Yeah?
But to write the offering memorandum, you would come to your notes from this class.
Okay, so hold on. I'm coming to that, okay? So you are the administrator. You don't have the freedom to choose the value of most securities. They have to be valued according to it. Of course, stocks, bonds, exchange traded instruments, no problem. It'll be weird if in the offering memorandum we say we price those according to some formulas. What? I mean, Apple stock, its price is here, it's on Bloomberg. Where are you gonna give me a different price, right? But snow swaps, we've never seen before. Then you have to see, what are the valuation principles for a snow swap? That has to be there, that has to be written there, right? Now, who wrote this? Our lawyer. So lawyer, what does it say here in terms of the valuation of the snow swap? What?
We can only do snow.
I cannot hear you. You have to speak up.
We can only do snow swap.
We can always. Can you hear him? I cannot hear you. You're very far from me.
So like we can only do snow swap on that. It says you can only do a snow swap.
You can only do snow swaps.
Snow swap.
No. How do you price a snow swap? It's December. I have some swaps that I entered into in August. I want to know the price of those swaps in December. If I buy Apple stock in August, come December, I know the price of Apple stock. I check it in Bloomberg, it's 137. That's the price. What about the snow swap? What's the price of a snow swap in December? Or in January, or in February, or that has to be written in the offering memorandum, right?
Yeah.
Oh, how do we value the swap? Perhaps you can write down a very complicated. Sometimes you do, but for a snow swap, there's nothing you can do. So this instrument will be priced at cost. That's it. Which is, how much did you pay for that? I paid nothing. Then it's worth nothing. And then one day, when the swap generates payments and say, oh, I got $10 million from this and that, great. And now it's valued at $10 million. So the valuation chapter in this fund is going to be very simple, because you do securities which are not exchange traded, they're going to be valued at cost, right? And then they're valued at, that the swaps will never be worth anything. However, because and you're the lawyer, sometimes the fund is entitled to a payment or will get a liability, and that will come from the fund. But there you're valuing the cash, not the security. Understand what I'm saying? Yes? So the value of the security called snow swap is zero always. But that generates liabilities, which are called contingent liabilities. It's a liability as a function of something happening. It's exactly the same as the option was in our 33-cent game. Everything is coming together now, right? But then when it's a contingent liability, you value the liabilities when they happen, not before. Okay? So to do the administration work for this fund is very, very, very simple. You say, what do you have? How much money in the bank account? $2 billion. Great. What other obligations, assets, and liabilities have? You have the securities. Where are they? Snow swaps. Okay, let me look at the snow swap valuation chapter in the OM. At cost. Okay, great. Zero. I'm done. There you go. Here's my bill, by the way. How much do you charge? Say 5 basis points, right? 5 basis. What's 5 basis points of $2 billion? This is the most interesting math you need to do. Okay, you need to calculate how much money you make. Okay.
0.2 million.
Huh?
0.2 million.
200,000?
Yeah.
Really? I think it's really.
So,
2 billion? 1% of 2 billion is 20 million, right? So 1 basis point will be 200,000. So I think it's 1 million, no? 5 basis points, I think will be 1 million. I think it's 1 million. I think it's 1 million. Okay? 1 million for that. Okay, well, that's a lot of years of studying accounting and this and that, but it's 1 million. It's good. Yes.
So if in December now we're doing the evaluation.
Yeah.
And then so my snow swaps aren't executed, so they're
Exactly. They're still live. Yes.
But then there's some other company are willing to buy them at like say 2.5.
Oh, yeah. Then you sell them. Yeah, sure. Then, yeah. But then what happens is this: the other company will buy them at whatever money, right? And then it's the same thing. You sell a security which is worth 0, and then you get $2.5 million in cash. Then she values the cash.
Okay.
The security that went out is 0.
Okay. So
Right?
If I choose not to, then it's still 0.
Exactly, and that's your choice, right? Because you're changing. See, that exchange of something like a snow swap, which is worth nothing. Say, oh my God, you sold something that is worth nothing for $2 million. That's a great. How did you manage to do that? Well, the thing is that the value is a fictional value, right? It's sorry, not fictional. It's actually the only true value, which is the accounting value. But the intrinsic value is very high. But you cannot be in the business of pricing intrinsic values, right? By the way, I've never seen an accounting statement where the value of something is a stochastic integral of who knows what. Stochastic integrals are very bad accounting mechanisms. You will probably never see them. However, they are part of your thinking. I get rid of the security for that price. You understand what I'm saying here?
So the stocks would be considered as cash in accounting.
No. Her accounting is one thing. Your trade is a different thing. I want to make sure that you understand that it's a completely different world. In her world, this swap may generate something, may cost me something, but the value is 0. Valued 0, right? You say, oh my God, I just learned that this is going to happen. I got to get rid of this immediately. Someone's paying me $2 million, right? For her, that looks like a good trade. For you, it's probably a fire exit. Doesn't matter. That's your job. That's her job.
Okay.
You understand? Right?
So would she consider stocks at 0 too? Or?
Hmm?
So would she consider like stocks at 0 value too? If I'm putting stocks?
Do you see the stock or the swap?
Stocks. Like some more liquid.
No. Again, it all depends on what this chapter says, right? But for stocks and bonds, they will typically be priced at, stocks for sure, they will price at market price. Let's say bonds, for example. Bonds don't have a price, right? Then what do? You get, there may be a valuation principle that says, we're going to get 5 quoted price from prime brokers, 5 brokers, and we take the average. That's as complicated a calculation as she can do. Look at 5 numbers, add them up, and divide by 5. That's already complicated. Understand what I'm saying? Accounting has to be very, very simple. Why? Because it can be challenged, right? It can be challenged. It has to be completely precise, accurate, and there's just no way that anybody. So it has to be at that level. You add 5 numbers, you divide by 5, and that's it, right? And maybe one day the bond only has 4 bidders instead of 5, and then what do? Well, maybe there's another section in the valuation chapter that says you divide by 4, because there's only 4 bidders. That's what the administrator will do. Yes? Okay. Is that clear? You understand how this works? And you can be working at an administrator. Why not? Some of you may work there. Typically, they will hire people with an accounting degree. What's your degree? Math, just math, right? No accounting. No, then you're probably not going to be hired for doing these jobs, but you never know. You never know, right? You never know. Yes.
So in this example, you asked us what job we could do, and then you made us argue that we were actually worth hiring.
Yes.
In practice, is that typically how it works?
In
Like-
practice, no. In practice, the job exists. There's a job description that someone has already done, and the salary is typically more or less fixed. But there, what you have to do is the reverse of what you're doing here, right? You say, oh, this is the job, and you need to go to the job interview, but the thinking process should be the same as what you did here. It's a mistake to go to a job interview thinking that it's like a homework assignment. They ask you questions, you give the right answers, you get the job. No. In fact, at universities, we typically train you the wrong way. We train you to give the right answer to the question, then you get a good mark, right? No. It's not a competition in that sense. There's a role you're fulfilling. You need to know what the role is. The job description will give you clues. But it's good if you understand, those columns, wherever you're going. Understand the columns, figure them out, do research. That's the research you do. Figure out in which column and in which row you are. And then that's the real job interview. And whatever questions they're asking you, maybe that's not the relevant question, right? You still have to you still have to say, oh, he or she is asking this, but if the job is to do that, then they have to know that I can do this, right? They have to know I took an accounting course, right? Although it may not be part of the question, because you are fulfilling a role. And it's not that it's check, check, check. Typically, hiring does not happen like that. You need to understand the row and the column you're in. And that's the same exercise we did here. You understand what I'm saying? Even if you apply for a very well-crafted job description and the salary is there, you're still fitting into something, and you need to know what it is.
So the problem in the interview is not so much the correct answer to the question, but how does this apply to the role that I know?
That's my advice, right? Again, it's not a midterm.
Yeah.
You go there, they asked me these 3 questions, I answer 2.5, I think I got the job. No. Okay? All right. Let me continue. I could spend a long time with these things. I think I'm going to just end this quickly. I have only 1 hour left. And let me just talk about the growth aspects of the life cycle and then the death, and then we'll take a break. Okay? So the growth typically is the growth of the assets under management, AUM, right? But then there are a number of issues here, which is the fees, the capacity. The best example I have to describe this is this one. Imagine that I have only 100 swaps, okay? But after a year, we're so famous that not only Elon knows about us, but Jack Ma and Bill Gates, all sorts of people, they like what we do, and they say, will you take my money? And I have another $2 billion. You have $2 billion that I want to bring into the fund, right? What happens if I accept them? So these are financials currently, 2 billion, 200, okay? But let's say that I get from the other friend, they are your friends, right? So you call Bill Gates and say, oh, he wants to give us money too. So let's say that we have $4 billion. You'll be very happy with that because I'm paying you, I forgot how much, but you're going to double your income, right? But say, wait. Let's see what happens here, right? I have now the CFO is very happy because we have $40 million of income versus 20, right? The performance fee is now 32 versus 36 because we took a bigger chunk, but we're still making more money than before, right? So is CFO happy? CFO is happy, right? Are you happy?
Maybe more money.
Are you sure? Are you happy?
It's making it harder to sell though because of profitability.
Well, let's see here. There's something wrong here. Okay. Are we worried now as a firm? Are we worried? We don't care. 72 million. Let's take the money. Well, and run. That's the only thing you can do, because your investor is just going to say, what? Give me my money back, and then our firm is finished, right? And very likely our reputation is linked to this firm, and that's it forever, right? So maybe this is a good deal for me, and then I retire. But you guys still have your career in front of you. That's something we never mentioned, age, right? You understand? So maybe I am incentivized to just do it, and then you say, damn, this is the last portfolio management I'll ever have. And then you say, damn, yes, I got this money, I'm doubling my income, but that's it. And by the way, Elon and Bill Gates will hate me forever, right? Understand what I'm saying? Then what do? I say, no, let's do it. Let's do this deal. Let's say we do this deal. Oops. No. I'm not in death yet. Sorry, I needed to, I clicked the wrong button. You understand what I'm saying? So what would you do if I'm the old CEO just wants to retire, and then what do you do? What do you do? Can you stop me? The chief compliance officer? Maybe you give him a call. Can you stop? He's the only one who can stop me, right? Right? Because I'm doing something that he can argue goes against the interest of my investors, right? And that I cannot do, because I don't want to go to jail. I want to retire, but not in jail, right? See what I mean? You understand? It's a bit of an exaggeration, but you understand what I'm saying, right? But I say, no. It says right here in the offering memorandum, I can do this, it's no problem. My performance is still going to be pretty good. It's going to be, I say here, you're still 3% above. But you think this is terrible, what do? You leave. My advice to you, this happens, the CEO wants to do this, my advice to you is you leave. Well, you still can, when your reputation is not tarnished by that. Leaving $3 million? How much money were you making?
3 points.
3 point something, that was a lot of money, right? I would do that. I would consider that, right? And maybe the same for everybody here. You see this thing happening, the CEO wants to retire, doesn't care. If I'm the CEO and I don't want to go down the path of history like this, I certainly don't allow this. I'd rather have a business which everybody loves and is making me 56 million than this one, which will last exactly a year, where I make an additional 16 million and that's it, right? But again, you have to know in which row and in which column you are. Because if you don't know that, you can be doing the funniest, most entertaining correlations ever. So what? You want a job? Yes? Well, that job is about to disappear. You understand what I'm saying? So this is growth, but very quickly leads to death. And there's different ways of dying, right? One is fraud. We didn't talk about that. That would be this guy, Madoff, right? Performance drag. That's what we discussed here. The fund is no longer a good product. A blow up. You may have heard in the news. Someone does this silly trade and then it blows up and this and that. Or the investors don't like you anymore and then flows just disappear. Salesperson cannot sell. You're done. This is the guy that I mentioned earlier, Bernie Madoff. He died in jail recently, a few years ago. Bernie Madoff was the broker. He managed the money. The administration company was controlled by him. That is an ecosystem to commit fraud, right? We're not talking about fraud in this course so much, but at least I need to mention that. Okay. Anyway, that's it. But this is a more interesting way of dying. Let's say that and this is from the Global Mail, right? Report on Business. You're reading the newspaper one day, and then it says, an article, how did Interwest rack up so much debt? I say, what's happening here? Then you read about a company called Interwest that is about to go bankrupt. You know Interwest? Have you heard of Interwest before? You know Interwest? Yeah, so the Interwest is the owner of all your ski resorts. You read that in the newspaper? You're the owner of all the swaps, right? It's your trades. Bad news. Because if Interwest goes bankrupt, now what are you doing? You're praying for global warming, right? You see what I mean? You need to pay them money. They're not going to pay you the money. They say, oh, let it be a very, very, very warm winter, because they're not going to pay you, right? Or I could give you the opposite. You can say, oh, all the cities in Canada are in trouble because of something done by someone, and then they're not going to pay. Damn it. That happened in 2008. There were some defaults that were from cities. Okay, we're not going to get into that, but this now links with the thing we discussed last week, right? And now you have a whole chapter. We could spend hours and hours just analyzing this swap. This really is the right example to understand how investments happen, okay? Even how they die, right? Okay, great. I think I'm gonna end it here. We're gonna take a 10-minute break, and then when we come back, we'll see, we mentioned some mathematical tools. I need to put them into the right context, and then we will end the class for today. So 10 minutes. What I'm going to do now is to move away from the example we just saw and start to develop the mathematical elements, some of which we have seen and other which are new. This should be fairly easy. My main objective today is that you get a good grasp of the investment sector and the considerations that matter. But I will introduce some of the math that is relevant for that, okay? And then next week, we'll do something different. So the first thing that I'm going to consider is the concept of portfolio return. Portfolio return is written here. This is a concept which is based on the share value or the value of your investment. Could also be a stock, could be a bond, could be any asset. That value is what the share value is, and the return defined every day, every month, every interval is the number you have here on the screen. The log return is similar, but there we use the logarithmic, the logarithm of the division between the prices today and yesterday. And as we will see, there's some situations where the log return carries meaningful information, the return carries meaningful information, but at the end of the day, they both are mathematical constructs. They both are human constructs, and we need to know which one matters as a function of where we are. Okay? And this is how time series started to be of relevance in finance, because from returns that you observe every day, every month, you can have a time series, and that time series is considered to have information. The information in the time series is going to be extracted using mathematical elements, mostly portfolio statistics and probability. And I'm here to tell you things that you already know, but maybe to make a reflection on two objects which are important in understanding time series. The first is the cumulative distribution function of the measure given by our historical observations. This is what typically the probabilists like to use. The cumulative distribution function is obtained from our time series by calculating the probability that a certain return is less than or equal to a given value, and that gives you a curve, the curve you have here in green, which expresses quantiles. This is the quantile y-axis, and in the x-axis we have returns. So to say that, for example, the cumulative distribution function of a point x is 0.25, that means that the probability that my return is less than that is the 25%, okay? Or to say that x is the bottom quartile of my distribution. All these things are the same. With the cumulative distribution function comes the density. The density is what many people in the investment sector know better than the green curve, because Excel gives you the histogram, and this is what people use. They use the histogram. It's the same thing. And both are related with the expression that the density is the derivative of the cumulative distribution function. Okay, so this is a thing that you know. Thing that you also know is that this object called the average return or the mean return, which is given by this expression. Now, some people think that this is the definition of the average return. It is not the definition of average return. Okay, here we take the monthly return or the daily returns of our time series of our investment. We have a number of months or days, sometimes years, labeled by a certain label I, and then the sum of that gives us the average. But this is an estimator, it's not a definition. The definition is something different, which we will see in a minute. Same thing happens for the volatility. Here what we have is the sum of the discrepancies between the observed number and the average with the square added, divided by n-1 and then the square root. And both of these are estimators. The actual definition is here on the left. The definition is what you use probability for, and the estimators is what you use statistics for. The relationship between statistics and probability, as you know, is very strong. Probability is used to make statistics make sense, and statistics is the thing that you can actually use. Statistics lives in the world of Excel with real data, lives on planet Earth, whereas probability lives in the sky, in heaven. Is probability deals with concepts. That would be, if you want, the world of ideas of Plato, whereas the statistics or these estimators would be in the world of shadows, also following Plato, okay, and the Platonian way of thinking. You can say this is in heaven, you can say this is on Earth. Statisticians spend their time on Earth with spreadsheets. Probabilists spend their day in heaven with ideas. But what we want is that things are on Earth as they are in heaven. We need probability and statistics to get along. Not always they get along, as you will see. Okay, not always they'll get along. So we're gonna have this this perspective on Earth and heaven, always aiming that they are the same. One of the things that you will encounter when you go into the world of investments, more than in banking, you're going to be surrounded by people who know very little math. And you're going to be surrounded by people that know very little math, but think they know a lot of math. And you're going to be surrounded by people who think they know a lot of math because they're very good with Excel. Okay? And there are people who just don't understand what a multiplication is, although Excel will do it for you. Just be aware of that, okay? I like to say that especially in the investment sector, mathematics is a very good nonsense detector. Many people believe anything that comes out of Excel. Excel never makes mistakes. It's true, Excel does not make mistakes, right? There are very few bugs in Excel. That doesn't mean that a graph given to you by Excel has the meaning you think it has. And we're going to see examples of that now, all right? So this is my first example. Imagine I have a fund that I start with my own money, $1. I have $1, I start my fund. Then in January I have $1, then in February I have $2. I doubled my money, okay? But then I lost it in the month of March. But it's okay, I made it back in April, to lose in May, to make it back in June, and you understand how this goes, right? Well, there's something very interesting happening here, because every month I make $1 or lose $1. When I make $1, I have a return of 100%. When I lose $1, I have a return of minus 50%, right? So what is my average return?
50%.
It's 25%. My average return is 25%. Of course, that's if I do the simple return, which is what most people do. You know that if I do my logarithmic return, my average is 0, right? But how about this? Say that we saw earlier in our snow swap example, we saw an investment that gave us 10% return on average per year, and we said that was very good. How about here? I give you 25% per month. Isn't that better? Isn't that better? You're mathematicians. You can tell that 25 is better than 10. Yes or no? No? 25 is not better than 10? Yeah?
Well, you know it's not good, but you need like a better metric. It's like a failure of metric.
Okay, well, okay, let's sure. But again, you're in a context, you're working, okay, and you have an investment which gives an average 25%, and then what do? It has a 25% average return, right? And you're a mathematician, you can tell 25 is better than 10, yes?
We have to figure out how they calculate it.
Well, no, it's right here. You're right here.
This is bad.
Right here. Of course, I'm exaggerating because here it's obvious you're not making money. But believe me, there are situations where this thing is not obvious. Okay? There are situations where this thing is not obvious. 25% average return. What's wrong with that? So of all people, you're a mathematician. You should be able to know that this is better than anything. Yes? That's 300% per year, by the way.
But the return is based on the current price of the asset.
Always is. So there's no swap, by the way.
I mean, like.
You would like some convergence to the mean, you know, like you would like the returns to actually converge to the actual average.
No, and they do.
It's like saying,
They do. I can give you graphs. No, what's wrong with this? What's wrong with this? Perhaps lesson number one. As mathematicians, you will feel very uncomfortable in this situation, right? First of all, there's nothing wrong with this. Nothing wrong with this. The fact that a return, which is a geometric object, has an average which is 25%, you know it's a geometric object, right? That's why the logarithmic return is there. But there's another way of looking at this, which is, if you look at the standard deviation, what's the standard deviation? The standard deviation is 75% for the simple return and 70% for the logarithmic return, right? How do you go from log returns to real returns? Remember Ito's formula? Remember Ito's formula? Ito's formula will tell me that the drift of my geometric Brownian motion is sigma squared divided by 2, right? What is sigma squared divided by 2? What's sigma squared divided by 2? Sigma is 0.70, right? 0.70 divided by 0.70 squared is what? You can do this. You're mathematicians.
0.24.
What?
0.245 is.
It's 25%. 25%. You can round 25%. So what you're observing here is Ito's lemma. Ito's lemma for a fund that has no return, right? This is the return given to you for free by the volatility of the geometric Brownian motion, right? That's what a mathematician knows. Understand? So here's a very good example of how math, actually advanced math. I mean, Ito's lemma is not something that everybody understands, but you do, right? Don't forget this example. Don't forget this example. All right, Ito's lemma. This is what explains this. There's nothing wrong with this. It's the interpretation that is wrong. And I have to tell you, in the world of investments, I've seen so many wrong interpretations. People don't really understand any of these things, but you should, okay? You're the mathematician in the room. Now, there's something which is also interesting here, which is another thing that people do with finance is they look at returns over time. And the time-weighted rate of return, which is the accumulation of monthly returns, is something that is very oftentimes used, right? So, so this is how it's done. I have another example here. I have a fund. I start with $1, okay? But I make $1 also in the first month, just like before, but I keep going. And every month I double. Every month I double. Every month I double. Look at my returns, 100% per month, every month. Every month. And then finally I get to the month of November, I still have 100% return, and my good friend Elon Musk gives me $1 billion, which I invest in my fund to lose half of it in the month of December. What does that do to my statistics? What does that do to my statistics? My cumulative return is 102,000%. I have the best manager of the year award, no question about that. But someone may be quick to point out that I actually lost $500 million trading. How is it possible that I lost $500 million trading and yet I have a return of 102,000%? Is there something wrong there? Again, there's nothing wrong there. It is just the result of what you do. Again, Excel does not lie. Excel does not make mistakes, right? But the interpretation of the number that Excel gives you is what merits reflection. Now, because of that, obviously I didn't make any money. The 10-year rate of return is fantastic, but because of that, there is another measure of return, which is the internal rate of return, which what it does is it measures the value I have as a function of what was invested in it. In other words, I weigh each return number by the assets I'm managing at that time. That should be the right thing to do, right? And of course, in this case, that's exactly right. Because when I do that, I get that the rate of return, the internal rate of return will be the solution to that equation, which I remind you is the same solution as the one for the yield for the bond. And the answer, yes. The answer happens to be minus 50%, which is what you might expect. So again, Excel does not make mistakes. That doesn't mean that the number that Excel gives you is what you think it means. Understand what I'm saying? All right. So there's a lot of that. As I told you, I like to think of math as a nonsense detector, and these are two good examples of that, right? Nothing wrong, it's just the interpretation is wrong. All right, on that, I have also the correlation, which you have here. Here you have the heavenly version and you have the earthly version, the one you can do in Excel. They all work, and the correlation, this is the covariance. The correlation is the division by the product of the standard deviations, and the result is a number between -1 and 1 by the Cauchy-Schwarz inequality. You all know that already, right? Good. But then what does that do for us? Well, in the context of investments, what that does for us is you have a portfolio that allocates assets to investments, then the covariance matrix, say, of my assets is a given quantity, then the portfolio volatility, as I've expressed here, is the product of my portfolio returns squared. You multiply that out, and what you have is the expression of the portfolio volatility as a function of portfolio weights and the variance covariance matrix. By the way, this is the reason why when we put 100 swaps together, the standard deviation dropped by 10. This is the reason why. Okay? If my correlation between the assets was not 0, but say 50%, the resulting portfolio volatility would be whatever this expression here tells us. And of course, we know that when we have low correlations, we have diversification, which tends to lower the overall volatility of our investments. So what we saw earlier with the snow swaps is something that happens with investments across the board. All right? All right, good. Now, at this stage, what I'm going to do is I'm going to tell you something that developed in the 1950s, and this is the division between portfolio risk and portfolio return. Harry Markowitz did something remarkable in the 1950s because he started to think about risk. And for that, he took into account, on the one hand, the expected return, as people have done for a long time, but for the first time, he took into account risk as a standard deviation. Now, I have to say one thing. He did this in 1952. In 1952 is when the first computer had just been built. So a lot of his theories would have been, actually they were ignored for a long time because we didn't have computers. Okay, maybe 20 years have gone by before people access to computers, people, not just big corporations, right? So in the 70s is when the first personal computers started to show up. And of course, it was then that his theories became relevant because there was no way to do these things by hand before then. But let's review what he did. What he did is he did a massive exercise in portfolio compression, the best neural network you can imagine, right? Very simple. He said, give me investments, I'll look at their return and their risk, I'll look at their expected return and their standard deviation, and that will help me tell them apart. It's an incredible exercise in compression. How can you compare investments by looking at only two factors? That's what he did. And a lot of his merit is he came up with the first two factors that were significant. Of course, now we don't do that. We have many, many more factors because we have very powerful machines. But you have to understand in a historical context, this was a great, great accomplishment, okay? And its result was that he could do something that was perhaps counterintuitive. I have here the curve that an investment in stocks and bonds will give you, in a stock and a bond. A stock and a bond will give you. Of course, if you have a single stock, stocks are riskier than bonds. So I have an axis which includes here the risk, and here's the return. That has very high risk, very high return. As I add bonds to it, I can see that the return and the risk both decrease. But look what happened. At some point, the risk curve turns around. Why? It's suboptimal to add more bonds to my portfolio. This happens when I have, in this example, 25% bonds, 75% stocks. If I add more bonds, the risk goes up. Why? That's the effect of diversification. Goes back to the formula we saw earlier, okay, where the portfolio volatility is the matrix product of weights, volatility of covariance matrix times weights. So in a situation where the correlation is less than 1, you have a nose like this all the time. Okay, and that's what he realized. And then he came up with the concept of, this is the capital asset pricing model. He came up with the concept that risk can be decreased by diversifying. And beyond that, what he said is, if I look at the world of all possible investments, what I have is, I just plot them into a plane. I'm ignoring a lot of features by doing this, I know, okay, but that's what he did. He had to ignore features because the year was 1952. There was no AI, right? And a lot of these things were done by hand or very rudimentary machines back then. But then if you do that, if each dot represents a portfolio, then you can put all of your investments on a plane to realize that there are two domains, two areas, two subsets of the plane, one that contains your possible investments and one that contains the impossible investments. There's nothing there. And then his consequence, or his reasoning was, well, if that's the case, then where are you going to invest as an investor, as a rational investor? You have to invest in the boundary, on the coast, okay, on the Mexican wall, wherever you want, okay? You have to invest on the coast. A rational investor will not invest there. Will invest either there, less risk, same return, or there, same risk, higher return. Okay? That's what he said. And then this is the efficient frontier. The efficient frontier is that line that separates one and the other. He didn't say where you invest in the efficient frontier. He just said that a rational investor will invest in the frontier. Every other investment is suboptimal. That's clear, right? Okay, now the person that came and told us where in the frontier we should invest, that was Sharp, another Nobel Prize winner. He told us where to invest. And he told us to invest in the point that maximizes the ratio of the mean and the standard deviation, the same number that we looked at the very beginning of class today when we were trying to decide if our investment was good or bad. Remember? Now, I want to tell you how I understand the Sharp ratio, because the first time I encountered the Sharp ratio, I was a professor. I read books and papers, and I wrote papers and books, and this idea of dividing mu by sigma, it sounded strange to me. My first reaction to the Sharp ratio is that it can't be right, because the mu and the sigma have different units. And typically, you like to divide quantities that have the same unit. Return has units of time to the -1, where standard deviation has units of time to the -0.5. So when you do that, you end up with a quantity that has units of time, right? So it cannot be universal. So I found that to be a little bit strange, but still there was a lot of papers and books that just went ahead with that. Now, when I realized what the Sharpe ratio was a little bit later. It's actually when I started my asset management firm, when I saw how people get paid in industry. And then I understood. So what I would like to do now to close my lecture today is I would like to have, I want to hire 2 people, 2 portfolio managers, okay, with slightly different jobs. You're one. Yeah, you see, he's going to, you have, okay, perfect. This is great. You're the other one, right? Yeah, okay. You see, they beat you to that. They are very well paid, okay? They're going to get, the base is very small. It's 150,000, okay? So a bit more than you, okay? But I'll start with you, okay? You will make $1 million if you give me 5% return. You give me 4.9, you are stuck with your 150. But you give me 5%, you get $1 million. You give me 11%, you get $1 million. Okay? Understand? That's his job. You understand that? That's an employment contract, and many employment contracts are written like this. Understand? All right, great. So that's what I'm going to do. So I'm going to start with you. This is your employment contract. You're going to get $1 million bonus if you give me 5%. I'm going to call it R, but it's 5%. Yes? Okay, great. So you're hired. You go to work. What time do you go to work? What time? When you go to work, what are you thinking? What are you thinking when you go to work? You're only thinking of one thing. That. Yes? We're only going to think about that, okay? You're not going to think where you go on vacation. You're not going to think how you're going to spend it. You're only focused on the $1 million bonus. That's all you think about, right? Okay, so what time do you go to work? What time do you go to work?
As early as I can.
As early as I can. Give me an What time do people go to work? 7:30. Okay. I like to, if you're going to know when people in the financial sector, especially, if you're going to know what time people go to work, what I recommend is go to Bay Street, Wall Street, or wherever, the financial sector, and look at what time Starbucks opens. When you go to New York, Starbucks open at 6:30. When you go to San Francisco, Starbucks open at?
Earlier. It should be earlier because New York.
3:30.
Oh yes, yes.
Starbucks open at 3:30 in the morning in San Francisco. Yes, no, people work there, okay? Yeah. They go to work at 3:30 because that's the time you need to get ready for, market opens at 9:30, right? You need to read a lot of news, you need to see what's going on and get your trades ready, because when the market starts it's too late, right? Okay, you go to work 7:30, a little bit 6:30. Okay, you go to work 6:30, and now what do? So here I am, I have a certain amount of money, I need to trade. What do? So I want to help you. What I'm going to do is I'm going to mathematize your job. I'm going to mathematize your job. Okay, when you mathematize something, you are so much closer to the solution, right? So in your case, what I'm going to do is I want to say, you're focused on the $1 million. You just want to maximize the probability that your portfolio will make 5%. You don't know what the portfolio is. You don't know what you're going to do. What do mathematicians do with things that you don't know? You give them a name, typically a Greek letter name. In your case, you're going to call them capital Pi, right? That's what the mathematicians do. Call it X. Well, we call it capital Pi. Say, well, I want to maximize the probability that my portfolio returns more than 5%. That's all you want, right? So how do I do that? You're thinking and you're thinking. And then you realize one thing, which is very interesting. You realize that your portfolio that you don't know will have a certain mean return and a certain standard deviation that you also don't know. So we give them names, also Greek letters, mu and sigma. right? And now you realize that your portfolio, the probability that it gives you 5%, the probability of your $1 million is exactly the same as the probability that this object exceeds that number. And it's very important that that's a number, okay? In your job, that will not be a number. We'll have to think differently. In your job, that will not be a number. I already advanced you, all right? So what we see here is that if my portfolio happens to be normally distributed, which is an assumption we're going to be okay with for now, then you say, wait a minute, if my portfolio is normally distributed, what happens with that? That's independent of the portfolio, right? That's the normal 0, 1 random variable. The portfolio disappears from the equation.
So all you need to care about is the mean.
According to this, yes, we're making a very big assumption that my portfolio is normally distributed. But if that's the case, and if I want to make $1 million, if you want to make $1 million, then you just introduce the cumulative distribution function of the Gaussian, and the probability you make $1 million is exactly what's written there. Exactly what's written there. What happens in the case of non-Gaussian portfolios, we're not talking about that, but you can figure it out as well as, let's stay with this, all right? Okay, so in that case, we just want to maximize what's inside. Actually, we want to minimize what's inside, which is the same as maximizing that. So this is the subratio with one very important difference. In the subratio, in the one done by Sharp, the R is the risk-free rate of return. What is the R for us?
Mine is 0.05.
For you is your benchmark in your contract,
Yeah.
right? That's, by the way, that's the difference between what I'm doing here and what Sharp did to earn the Nobel Prize. This is more interesting, right? This is more interesting. So you want to maximize that, and that's where the Sharp ratio comes from. That's why it's such a big deal. Because many employment contracts are codified to maximize the Sharp ratio. Is that clear? Yeah? Okay, great. So that's your job, and now that's all you have to do. Maximize this, and then you maximize the probability that you make $1 million. I've done your job for a year. Yes?
So in order to actually maximize it, like the idea is you simulate a bunch of portfolios.
You can, okay, that gets into another topic, which is the topic of numerical methods.
Sure.
That is linear. This one is quadratic. All right, so this can be done, you can do it with simulation, you can do it with quadratic programming, okay? And it gets to be a very interesting topic of discussion. And I have a full course on this, as you can imagine. Let me just leave it at that, okay? You can do it with simulation too, okay? How you do that is, I also advise that you don't assume that your portfolio is normal, okay? So when you get into the real, but this is the beginning. So I think with the beginning, we now say, wow, this is, you can do stuff here, right? You can simulate, you can do stuff, right? Okay, let me go to the next, I have 10 more minutes to do my next job, his next job. So his job is going to be different. It's another employment contract. You're going to make $1 million if you beat the S&P by 5%. Okay? Looks the same, but that's what I told you earlier. Now your benchmark is not constant. You cannot do the same argument as before, right? So what do we do? Well, I'll mathematize it for you again. And what I do is that your S&P 500, right? What I do is I take it to the other side, and then everything we did earlier works, because now I have my constant here. Again, that's a constant. So, and that's the cumulative distribution of the Gaussian, again. So, I maximize something slightly different. I maximize this ratio, which is called the information ratio, and the denominator is called the tracking error. And this is very interesting because I just said you're going to be hired to beat, say, the S&P 500 by, say, 5%, right? Well, that's what mutual funds do. They're benchmarked to an index. And that's how mutual fund managers get paid. You have to beat the index to get paid, right? Whereas in your case, this is how hedge funds get paid. They don't have a benchmark. And of course, the portfolios they do are different, right? It's interesting that in your case, if you have wonderful performance in a year where the S&P is down, that's not so good for you, right? Because if by any chance, when the S&P is up, you're down, even if it's just a little bit, or even you underperform the S&P, then your tracking error is very high. That means the probability you're going to beat the S&P on a given year is very low. In fact, the way they analyze and the way they compare mutual fund managers, you're probably going to be fired. Again, it's very important to understand in what row and which column you are. All right? This is what you would do if you work for a mutual fund and you're paid like this. And the other way is what you would do and you would pay when you have a different contract. Now, this is the interesting part, and I'll end with this. I have several slides on this, but I'm just going to ignore them. Just listen to me, because I'm going to optimize your portfolio with my hands. Very simple. You need to beat the S&P 500 by 5%, right? And you're hired to obtain 5% without a benchmark, right? How about this? How about this? You put all your money on a futures contract on the S&P 500. That gives you the S&P 500 return, right? Great. But now this is a futures contract. You only have to put 5% down, right? I'm exaggerating a little bit, but you don't understand, okay? In fact, allow me to exaggerate even more and allow me to see that your margin is zero, which is not true, but okay? And now you have all your money there and you have a futures contract on the S&P. And now what you do is you hire him. Said, what do you manage my money to? And if you make 5%, I give you $500,000. Right? What do you say?
Sure.
Sure. I mean, you're going to do that work. You don't have to even pay him anything. No salary, right? He's doing the same work. It's just more money now, right? Right? And what do? You go on vacation for a year. You have nothing to do, right? After a year, you see, oh, let me see, oh, I got it. You give me $500,000, you collect $500,000, you haven't worked at all, right? And you understand what I'm saying? This is very interesting because it shows you how the asset management world works. There are people like him who are making money, and then there are people like you who are just buying what other people do, and then you just add what's called beta to that. Okay, beta is, I can add an index return to that. The next slides that I have here is about linear regression and portable alpha, and that's what that is. But it's most easily expressed this way. You just buy his alpha and you add beta to that, and the beta is what you have in the S&P 500. That's what we have here. Yes?
I just wanted to ask, for the Sharpe ratio, do hedge funds still use it like trading?
No. I mean, I'm using the Sharpe ratio, assuming we're in the 70s. Okay. I mean, now we can do better things, and people will say, "Oh, the normality assumption is not a good assumption because of this, and this." Right. You have to modify this. So I'm not giving you this to tell you this is what you do. I'm telling you this so you understand a framework. It's an approximation framework, okay, where these things actually are correct. But then you have to take into account the realities of the market you're dealing with, where things are not Gaussian. But it doesn't matter. You at least have the first steps towards this. And next week, when we look at trading strategies, we will use the Sharpe ratio because we just see how useful it is. But then, as usual, you need to take into account that there's other things that will make your return not normal, right? And therefore, you need to understand these things with great care. Okay. And by the way, let me continue with the analogy, because now I have the mutual fund and now I have the hedge fund. Hedge fund, zero benchmark, 5%, just like our snow fund, right? 10%. Markets go up and down, I don't care, 10%. You, mutual fund. Markets down, you should be down, right? Market's up, you should be up, right? But what's the problem? Go back to, will you take his money? Will you take his money for $500,000 of worth of fee? We all said yes very quickly, but remember what I showed you earlier when we went from a $2 billion fund to a $4 billion fund. You're looking for alpha. Alpha is very scarce. It's easy to make money when markets up and down. Yeah, you can do that, right? But alpha is very scarce. So maybe you say no. Maybe when he says, would you mind managing this? I said, no. Why? I mean, you're not doing snow swaps, but you may be doing trades which have limited volume capacity, right? I said, no. If I take yours, my performance now comes down like before. And you see this thing, which mathematically was obvious, suddenly when you come to the real world, not that math is not the real world, but you understand what I mean, right? When you go into an actual enterprise, into an actual company situation, things that seem to work, now they break down. Your performance may degrade if you take his money, so maybe you say no. And now you see how the asset management world works. There are people who produce alpha and people who produce beta. And that today is still the case. I'm not saying that things are normal, I'm not saying that things are linear, but you still have alpha producers and beta producers. You still have people that produce performers like the Snow Fund or other things, which is extracting value from opportunities, or people that just go with the market up and down. All right? Okay. What I have remaining in this part of my lecture now is how these linear theories are show up. And linear regression analysis is how these things are done, right? Some investments are directly dependent on the move of market factors like we have here, and others are not. Alpha is not, beta is. And alpha and beta are terms which are obtained from linear regression. I have an example here. These are two investments, right? The return differential is what the beta is. You have my monthly, these are monthly returns. My monthly returns are there, and I can see that there's some commonality, but one does better than the other, right? And you can express that in the statistical linear regression that I'm sure many of you have done. So you do that. But by the way, you can only do this on the returns. You cannot do this on the prices, okay? Prices are auto-regressive. It won't work. Okay? You know that. And linear regression is the way to express the dependence of a certain investment, in our case, to other indices, index factors, like the ones we have here. These are the returns under our consideration. These are the market indices or the benchmarks that we use to understand the investments that we're dealing with. And the betas are the solution of a linear system, very easily calculated in the case that the factors are independent, and you know that this thing expresses the difference to the regression line, and all of these things are things that you already know. And you can do this also in higher dimensions, right? With betas which now become vectors and so on and so forth. So all of this is how normal returns and linear dependencies show up. In week two of this course, I need to remind you what we discussed there, because it's the extension of this. I told you about regression trees and classification trees and how machine learning is used to enhance this. So at this point, I have to loop you back into week two and look at the last hour of week two, because it's the natural continuation of what we're doing here, and that will be the modern way of getting released from these Gaussian assumptions. Okay? So now we will have to go back to week two, and everything we did there will apply here. But of course, I'm not going to do that. I'm going to end my class now. We continue next week with a description of some trading strategies, so we understand how these things actually happen, not with snow swaps that have never taken place, but with real stock, bonds, and other instruments, which is what people do. Okay? We're finished.
Thank you.
Thank you.